For Your Money is brought to you by NelsonCorp Wealth Management.
It's now time for Your Money. We're joined by David Nelson, CEO of NelsonCorp Wealth Management. Welcome back, David.
Thank you very much, Brandy.
So with interest rates creeping up this year and inflation going higher, bond performance has lagged. Share some thoughts on that segment of the financial world.
Certainly been a rough patch as far as for the bond market, not just in the U.S., but globally. And I think I'll start out kind of explaining to people a simple way to think about bonds and how they work. And that is a teeter-totter. So if you visualize the teeter-totter as far as when interest rates go up, one side goes up, the other side goes down, and vice versa. Well, we've been in a period of time since going back to 81, where interest rates were 15, 16% back then. Today, we're looking at very low rates, 1.5% as far as on government bonds. So it's been a real challenge, as far as to say the least, as far as individuals investing in that space. I brought along a chart I think that'll help people as far as to be able to see here. We've got on the far right, kind of the oval circling it there. And that is showing as far as performance year to date, as far as for the global bond fund. It's negative, almost 4%, one of the worst years that we've had as far as for bonds. All indications are, as far as with interest rates ticking up like they have been, that this trend's probably going to continue as far as being a very rough year as far as for bonds.
Okay, so what implications does that have for other areas of financial markets?
So there's no segment that acts in a vacuum. So when we talk about stocks, they've had a terrific year. We look at real estate, it's had a phenomenal year. And commodities is another area that has actually done quite well. With current rates as they are, with the indication that, again, rates are going to go up, not a lot of people are looking at bonds as far as a legitimate option as far as to put their money. That may be a mistake. They're looking at stocks and real estate and commodities saying, that's pretty much all I need. Certainly not the case as far as from our recommendation, as far as to the people we work with.
Okay, so what should viewers be thinking about given these dynamics?
So it sounds pretty negative with interest rates at 1.5%, but that's on a safe investment. Now contrast that to individuals that have money in stocks and bonds and in real estate. A 30 to 40% drop can happen, and oftentimes does happen. You don't get that with safe bonds. I'm not saying, again, that one size fits all for folks out there, but the reality is that people need balance. And in periods of time like now, people start reaching for yield, they increase their risk, and we want to be very careful about doing that.
All right, David, as always, thanks for joining us.
Thank you, Brady.
If you missed any of our discussion, we'll make it available for you on ourquadcities.com.